the first couple of results out today. Let's talk JB Hi-Fi because it outperformed. We saw it gain a little bit of ground in the market today, even after gains last week on the back of expectations around this result. What did you make of the actual numbers though?
Kate, I think a sense of relief coming through from that retail sector, given that we have seen downgrades from the likes of Super Retail as well as the Reject Shop in 2014. But JB Hi-Fi, really no surprises here. We heard that update on the 28th of February, and basically the numbers coming in right on line with what they said in the update. Net profit up by 10% at $90.3 million. We saw gross margins up 11 basis points at 21.6%. Total sales up by 6.8% and like-for-like sales up by 2.8%. I guess with JB Hi-Fi though, since that 28th of February update, we had actually seen the shares down by 6.2%. So some of those losses reversed. And the other thing to remember is this is still one of the most shorted stocks on the market, despite the stock being up 80% in the past year. About 8.6% of the stock is shorted, making it the 17th most shorted stock on the market. Still, that's better levels than what we saw in 2013. In 2013, it started off the year being the most shorted stock on the market and ended the year with the biggest reduction in short positions. So it does look like some of those shorts being closed out today, and we did see a good performance by the end of the trade.
About David Jones and Myer. Julia Lee from Bell Direct, I wanted to get your take on this one. It's certainly attracting a lot of attention, isn't it? This potential merger between our two department store giants. What kind of chance would you give this of going ahead?
I think strategically it makes a lot of sense because department stores have been under pressure because of their big international brands coming through like Zara, H&M, Uniqlo also due to hit the market this year, and talk that Marks & Spencer is going to hit the Australian share market. So it's a really tough environment out there. But I think the issue with this going ahead would be competition. Myer is the #1 department store in Australia and David Jones is #2. Strategically, it makes sense. There'd be a lot of synergies, probably more than $85 billion worth. But what you'd probably see in the case of a merger is a lot of these properties closing down, and that's because David Jones and Myer, if you go to any capital city, they're basically a stone's throw away from each other. Also, there's a question around strategy. They do target different demographics, so would really a merger make a sense in that regard? I guess what's been fueling...
But Julia, they would stay separate according to the proposal Myer put forward.
Even if they do remain separate, they'll still face the same challenges. I guess still some benefits in terms of back office and being able to consolidate that. But I think it's more likely that perhaps an international buyer could come in here. We have seen consolidation in terms of US department stores. We have a look at some of those department stores and where the multiples have been. We've seen Neiman Marcus selling for 10 times EBITDA, and we've also seen Saks on Fifth Avenue selling for 11 times EBITDA. And really, if we apply those types of multiples to David Jones's FY14 numbers, or what's forecast, what we're expecting, that would give it a price range of between about $3.66 to about the $4 mark. David Jones today just trading below that $3 mark. So I think competition is still a concern. After all, Myer is the #1 department store and David Jones is the #2 department store, and I don't know how it's going to get through the ACCC, but I think David Jones is a likely takeover target, because if the US experience is anything to go by, one of the attractions of this consolidation have been the property portfolios which have underpinned these US department stores. And of course, David Jones has a huge property portfolio. If we have a look at the 3 key properties, the 2 in the Sydney CBD and 1 in the Melbourne Sydney CBD, they're probably worth around about 90 cents per share, just based on the current book value on that it's recorded at.
On the, I guess, in the headlines today, although not quite as much as our major players, was Country Road. Julia, I know you took a look at this one. What did you make of those numbers?
This is a smaller company, but a record profit result coming through. We did see profit up by a massive 72%. And part of what Country Road has been doing is growth by acquisition. We saw it acquiring Mimico as well as Witchery, and we've really seen those numbers starting to hit the balance sheet and hit the books, and that's been good. We've seen total sales up by 27.4%. A lot of that growth, though, coming through from South Africa. On a like-for-like basis, we did see South Africa's sales up by 13.6%. But of course, for investors, if they want to get in on this one's a really difficult one, because 88% of the stock is owned by South Africa's Woolworths, and then another 11.9% is actually owned by Solomon Lew. So that leaves only 0.1% of the stock actually in circulation. So for all of 2014 so far, we've only seen 40 stock changing hands. There's 40 shares changing hands, so very illiquid. But I think it's just another encouraging sign that there are retailers doing well out there despite the really tough environment.
Yeah, Julia, and I should mention to viewers, we'll be speaking with the CEO of Country Road tomorrow during Business Agenda at about 6 p.m. Australian Eastern Daylight Time for those who are interested. Julia, just quickly back to you and the companies in particular you'll be keeping an eye on this week in terms of earnings now.
Well, if we have a look at the half-year earnings season, which is in February, I think it's important to just watch what the market's expecting. And consensus still stands up 14% for the full year. So we'll be watching to see whether that is going to be adjusted, and that's going to have a bearing on the direction of the market. Now, resources as well, a lot of the growth should come from. In fact, excluding resources, the consensus growth forecast is 8%, and excluding resources and the banks or financials, the growth is only expected to be at 5%. There are a few themes driving the market at the moment. I think one of the stocks and themes that will outperform are those companies and money managers which are tied to overseas operations. So things like Henderson Group, I think, will outperform. Challenger should also do well, and that's due this week. The Australian dollar should also be a key theme, so that should be good news for the miners as well as the exporters. Now, we know that the housing market has been going quite strongly, but there does tend to be a little bit of a lag, around a 6-month lag, before the very strong housing market really hits the profit numbers of some of these housing stocks. So we won't be expecting too much from those housing-related stocks. But I think the mining services area is a one to watch in a negative sense, and we'll be watching some of those contractors like Monadelphous as well as Leighton's to potentially underperform this earnings season.